Okay, hi Alice. We saw you at Christmas and we discussed the outlook for 2010. You've performed extremely strongly in the first half. Do you want to give us a flavour of what's been going on?
Well, it's been a very surprising period for us. I don't think we expected the degree of stress that we have seen in the Eurozone in terms of the political and economic stresses that have emerged in the periphery over the last 6 months. But within that, we have found that we've been able to focus on the higher quality businesses and the stronger franchises in Europe, those businesses that benefited from currency weakness with a lot of international exposure, and in a market that we do think is pretty cheap overall on a sort of longer term basis, we've been able to really focus the funds on the best ideas in those spaces.
Well, you're clearly doing something very right because your performance has been fantastic. Have you managed to avoid most of the pitfalls?
Exactly, and I think a lot of the performance again in the last 6 months has really come from more sector positioning and being in the right countries within the Eurozone, as opposed to what usually drives our performance, which is our stock bets. So the last 6 months we've gained from a significant overweight in the industrial sector. We went from a sort of neutral to a very large overweight position in Q4 last year because we felt valuations were really underestimating the potential margin performance as the global restocking cycle kicked in. So we benefited from that exposure. We also benefited from the consumer exposure that we have. Again, a lot of very international companies based in Europe with attracting emerging markets exposure have been steadily outperforming over the last 6 months. In terms of countries, obviously we came into the year significantly underweight the periphery. That was as much an issue of valuation and the kinds of stocks that we were finding attractive as it was a view on countries overall. Obviously, as the year progressed, we reviewed our view of country risk and remained underweight for most of the last 6 months within the Spanish, Italian, Greek and Irish and Portuguese markets, the sort of periphery markets. Where we are today, we're starting to add back to stocks that have fallen a long way and that aren't too exposed to the domestic economies in that area. So in the telecom sector, we've been building exposure via investments in Telefonica, which has fallen quite significantly. And in the banking sector, we have been adding to Spanish and Italian banks in particular, given the valuations and given that we think that where we are today, the risks are overdone, or the valuations are really focusing too much on the risks and not the rewards, potential rewards.
We've heard a lot about sovereign credit risk in Europe in the first half of the year. Is it fair to say now that companies have got better balance sheets than their governments?
I think we need to look back to where we started this crisis. And 2 years ago, we were in a situation where most corporates in Europe were relatively underleveraged compared to other companies around the world. And the over-leverage was very focused on the financial sector. 2 years on, the financial sector has raised a lot of capital. Our view in general is that the larger banks in Europe, the listed banks in Europe, are reasonably well positioned now, having raised capital and reduced the risks on their balance sheet. So we think the financial sector is at a point of a long way through the repair, and the rest of Europe, balance sheets in general look very robust, and we see we see the return of share buybacks from many companies in Europe. We are starting to see capex picking up because cash flow is strong, and we're also starting to see some M&A at the edges. So yes, I think in general we can say the balance sheet risk is much reduced, compared to where we've been.
Sounds good. And when you've got risk appetite potentially picking up, if you've got a cheap market with less balance sheet risk, investors tend to go for smaller companies. Is that somewhere where you're positioned at the moment?
We started buying back into small and mid-cap companies Q4 2008, so a year and a half ago now. So for the last year and a half, we've been significantly exposed to smaller and mid-cap companies because they looked by far and away more attractively valued relative to the rest of the market. Now, after 18 months of very strong performance from that type of company, I think we're becoming more selective. And over the last 6 months, have been taking some profits in that space. But there are still, on a stock-specific basis, and I think that's the really key about Europe today, is that the differentiation between good and bad companies within sectors or within spaces in terms of large, small or mid-cap is very low. And so we can be selective within those spaces and still make a lot of money, both relative and absolute, we think, going on over the next 12 months. So we still do have exposure to small and mid-cap companies. It's just that we think we've had the easy win in the last 18 months, and now we need to be more selective.
And where do you see the risks lying in the second half of the year?
Well, clearly global growth is the big risk for Europe, because Europe is really living off now the growth that we are seeing, the recovery in the US and the growth in Asia. So 40% of sales of listed European companies comes from international markets, and that's where we're seeing the earnings surprises come from for Europe as we are today. So any double dip would make the restructuring that has to happen in domestic Europe much harder. We think the restructuring is happening. We're seeing structural reform of labour and pension conditions, and we think that's very positive for Europe over the medium term. But in the short term, we do need to see demand from outside of Europe to support corporate profits and employment within Europe.
Well, Alice, thanks very much. You've got fantastic numbers, so thanks on behalf of your investors, and keep up the good work.